Welcome. Good to have you. Today, obviously, we'll be looking at tax strategies for small businesses success. My name's Connor Spencer, and yes, before anyone asks, again, we will be sharing the slides with everyone. There'll also be a recording which typically goes onto our YouTube page, but I will actually, for anyone I speak to late this afternoon, just send it directly to you a bit sooner via email. Obviously, for anyone who is interested in hearing or reading about the other things we cover from Lawpath, from that kind of first-hand experience, I have included just now into the general chat some links. So you can see there are reviews, some video client testimonials. There's a YouTube link which will actually take you to the Lawpath page, but you'll also be able to actually watch a webinar I did last Tuesday. So if you are actually a subscriber or finding for the first time, in that webinar, I basically just covered some of the sort of key customization tools and software bits that we have on the platform. So if you want to kind of know what it looks like from a subscriber's perspective, or if you've been with us some time, want a refresher on some of the new features we have, definitely check that out. And then there's also a link to some of the hot topics, or most common things we're asked on at Lawpath from both a legal and accounting perspective. There's a link there. And then if anyone does want to reach out to me with any queries, my email is in the chat there as well. So for any of those who are new to Lawpath, we are an Australian-based online legal platform, and we also have some accounting and tax advice to boot. So we've actually been operating for 10 years, and we've actually helped over close to 500,000 small to medium businesses in different capacities within that time frame. So we're very much actually tailor-made for startups who need that, need the service to fill in their gaps in legal and accounting knowledge. But we also work with many clients who are, in need of requesting that kind of 6 to 12-month audit of their business, whether that's around their structure, any existing contracts they have, their intellectual property, and especially around this time of year, checking their compliance with changes in legislation, particularly on the employment front. We also help clients who are about to go through rounds of investing, and clients who are at that stage of selling or buying a business, and of course clients who need expert accounting and tax advice, and need their taxes sorted by some senior chartered accountants. So we are very much a one-stop shop for all businesses in multiple different industries. So believe me when I say you're not too small for us. You're not too small for ensuring you have a strong legal and accounting foundation for your business. I have, for example, I've got a client who runs a camel milk business in WA. I know a woman who works with a university and Australian Navy in Darwin. And there's lots of other businesses I work with who are cafe owners, trades, consultancy businesses, software development, and e-com stores. The list goes on. So they are a few of the many 400,000 plus businesses we have helped over the past decade. And the main thing they all have in common is that they are part of that $100 million there that we've saved for small, medium businesses in their legal and accounting fees. We are actually on track to reach the million businesses mark by 2030, and we'd love for you to be part of that milestone. So today, as you can see, we're joined by Tim Quinn. So Tim is a qualified chartered accountant. He's got 17 years of professional experience in tax and a business advisory at all stages of the business cycle, from startup to exit. He actually has extensive experience in supporting entrepreneurial clients meet their tax obligations and advising them on making the tax system work best for them and their businesses. And he's also run tax divisions at a director level. So needless to say, he is extremely qualified. So if you're actually also behind on having your tax lodgements or BAS lodgements prepared from last financial year, or you're not happy with your current accountant and want it all done by Lawpath, Tim will be your man. We will have a tax compliance offer, our tax plan for those who are in this webinar, so stick around to the end for that. And Tim will be covering for us tax considerations for different types of new businesses, tax strategies for Australian startups, and types of startup expenses that are immediately deductible. And then we'll actually finish with a bit more on how Lawpath and we can help you, and a Q&A session as well. So If you do have some questions, you'll see in the middle there, you should see a Q&A chat bot. If you just want to put in any questions you might have on the accounting and tax front, do feel free to pop them in there. If you have anything that kind of stems into the legal side, as I said, my email is in the general chat, the webinar chat. Do shoot me through a message there if you want to learn more about how we can potentially assist you. All right, so we'll jump right into it. That's enough from me. I'll hand things over to you, Tim. Thank you.
Thanks very much, Connor. Much appreciated. Hello, everyone. Nice to, I guess, meet you in a way. I see you've coming in from all corners of the, not quite the planet of Australia, north, south, east, west. It's really great to have so many people on board today. We're going to keep it pretty broad and applicable to everyone. So we won't delve into state taxes. Don't want to confuse things too much. There's plenty for us to get through. Let's start with some effective tax strategies for your startups. I see a lot of people on the call today are relatively new, and then there's a drop off, and then there's some people that are old hats and have been doing it for 5 years plus. Hopefully for those that have been doing it for a while, there's still some tricks up your sleeve. You'd be surprised. A lot of the concessions out there for startups apply to you all the way up to 10 years plus and up to $50 million of revenue. So you might not consider yourself a startup, but you might actually be in the eyes of the Australian tax law. Let's talk about some business structures. Now, this can depend if you set yourself up versus if a big accounting firm set you up. You might have two very, very different structures, and it's no guarantee that you're in the right one. So it's always good to have a think about what your structure looks like today. Most people will incorporate with a very simple structure. You'll get your PTY limited company. You might have two, mum and dad, potentially husband and wife, two partners, friends setting up a business together. You'll be both directors. You'll both own one share, and that's it. You've got everything within that company, and you go hell for leather and try and make a buck. It might be time to consider complicating that structure a little bit. And I don't say that lightly. Complication is not always good. Complication adds a little bit of expense. As you can imagine, having a more complicated structure takes a bit more doing, but it can be incredibly beneficial. If you've been trading for a little while, if you've got some valuable intellectual property that you've built up, if you've got some risks in your business, which most risks do, particularly if you're selling personal services, you can be insured to the hilt, but you can never be insured enough. It might be time to consider separating out your structure into what we call a holding company, which if you imagine on a very, very simple diagram is at the top. Your trading company will continue to exist where you're actually doing things underneath that. You might separate out an IP holding company. The only job of that company could be to own intellectual property and license it to your other companies. Maybe you want your holding company, instead of to be owned by you individually, to be owned through a family trust. There are tax issues, there are asset protection issues to consider with all of these structures. The dual company structure that I talked about, this holding above a trading with an IP in the mix somewhere, is a very, very tax effective structure. There are huge benefits to doing so, particularly if you're looking to, in the future, get additional investment. If you're looking to potentially carve out new things, have new businesses underneath your ownership, it's very scalable for investment. What we mean is, if you imagine that you're the sort of, you become a corporate group where you've got 4 or 5 different companies doing slightly different things. If you get in a new investor, having to update ASIC, the corporate regulator, for 4 or 5 new companies is very complicated and irritating process. If you can just put them in at the holding company, it's much, much simpler. So it's very scalable. When we talk about de-risking, you always want to separate as much as you can. I'll leave this to the lawyers to explain it in more detail, but your assets from your liabilities. So if you've got risks, try and keep your risks in one entity. Try and keep your assets, your value, in another. It just becomes a little bit more difficult to look through if you're ever pursued through the courts, and there's plenty of vexatious litigators out there that'll try and attack you in your business. So it's good to try and separate that out as well. Consolidated tax opportunities, just because you've got more entities doesn't necessarily mean more tax complication for lodgements. You can bundle them all up, and there are benefits to doing that as well, which we'll talk a little bit later on when we talk about tax leakage. It's very easy to add new companies into that structure. You've done it before. It's almost a copy and paste job. And like we talked about, these can be tax effective structures. We'll go into that a little bit more detail as well. The family trust. Now, for those of you with slightly better memories than me, a few years back, this became a bit of a political hot button topic where we were suddenly going to do away with the tax effectiveness of family trusts. And if anyone in the chat wants to guess as to why that didn't happen and both political parties backtracked, I'll give you a minute for the political reason of why you think that happened. But as they stand today, and as I predict they will stand into the future, family trusts are enormously beneficial for tax purposes, for asset protection purposes. They are a very common, very long established way of collecting and accumulating family wealth, including trading companies. If you have in this structure, your family trust sits above the holding company level. So it owns the shares in the holding company rather than you individually. You get that flexibility. As that income from your companies goes up the line, you're not obliged to declare it just to yourself. Potentially, you've already hit your top marginal tax rate. There's nothing more we can do for you from a tax effectiveness perspective, but you might have a non-working partner. You might have a corporate beneficiary. There's any number of things that this flexibility, anytime you're given flexibility in tax, you're able to change things around. You're allowed to hold things back to future years where maybe your income won't be as high. That flexibility can mean real additional money in your pocket. Tax minimization, again, we can do things like tricky things about streaming. It's beyond the scope of this, but again, more flexibility around capital gains and dividends and who gets them. Asset protection, like I spoke about, it's just another layer. It's you'll often hear, if you follow the news, that the Gina Reinhardt sort of stories and trusts are very common for that reason. You're separating out your legal ownership from who gets the benefit of it, which is very beneficial. And it's just a great structure for you to build your family's wealth. It's a very, very effective structure. Now, I can't see from the chat, did anyone have a guess at why family trusts are still going, in my estimation? I don't think anyone was brave enough, or maybe they weren't. I'll give you a clue. Politicians use family trust. Faith, that is the answer. About 2/3 of all Australian federal parliamentarians have family trusts. They are a no-brainer. They'll be there forever. Faith, thank you for putting your hand up for that one. That was tremendous. All right. Just check we didn't miss anything. Looking at your share capital, if you've set yourself up or set yourself up with perhaps an inexperienced accountant, they might have given you this one share each at $1. It's a very, very common structure. We just recommend actually going a bit higher, putting in $1,000 at 1 cent each, pardon me. So for 100,000 shares. The reason is, when you get investors in, it's much easier to do something with those shares. It's not infallible, it's not impossible. If you set yourself up with 1 or 2 shares, you can do share splits, you can make it work, but you're adding expense, you're adding complication later down the line that you could have saved if you'd just done it up front. Anytime if anyone on this call has had to deal with ASIC, the corporate regulator, they are hard to deal with. They are unforgiving when it comes to late penalties, and so it's just better when you're setting things up and you're in that mindset. We set it up with a higher number of shares. Capital raising, for those of you that are a little bit down the track, potentially you're looking to or already have external investors. As soon as you start doing that, you need to maintain this wonderful cap table, which has broken many an Excel spreadsheet that I've seen in my lifetime. It is, and I'm not turning you off Excel. Please keep some sort of records, because these things can get messy. It's why we really advise speaking to an accountant and a lawyer when you're doing fundraising and doing cap tables, because it can cause, again, so many headaches down the line if you don't do it right. If anyone's had to have that discussion about whether a share was dilutive or non-dilutive, or whether there was preference attached or not, if you don't get those records right, it can be a real disaster for you. So there are lots of rules of thumb. None of them are strict, but you see a very common thread through it. Most companies, however much they're seeking to raise, will typically give away 10 to 20% at any raise. You'll hear people talking about mezzanine rounds, Series A through H. The terminology isn't set, but it's reasonably common. You will typically give away a piece of the pie at every opportunity. The difficulty there is you obviously feel your ownership slipping every time you want money. Obviously, the idea is as long as you're growing that pie, giving away more pieces of it is okay. And sometimes it's necessity, frankly, as well. Create your financial models early that support that cap table. Have some real milestones in line when you're doing it and set those expectations. If you're bringing people on an early fundraising rounds, be upfront with them. Say, we'll need to raise another X million dollars in 2 years. We'd love to have you on board. Investors don't like surprises. Investors love a story and a progression that's mapped out into the future, and you can bring them along with that story too. Investors will get diluted as you will. So you might give away 10% now that for them becomes 5% at the next raise or less. That's the fact of life. Again, as long as the pie is growing, investors will understand that. I would caution you against trying to be too tricky and give away what we call non-dilutionary shares, which says you'll keep 10% for forever, because new investors hate it and will avoid it like the plague. Get your ASIC documents accurate the first time. Doing them late, doing them after you've forgotten in a fog 2 years down the track is a nightmare, which is the next thing here. Keep those records, get them signed. Digital signatures are fine these days. ASIC was dragged kicking and screaming into that, but they are okay with it. Get them docu-signed, get them, just do it properly. I thoroughly recommend it, and keep it somewhere really safe. Keep a cloud backup, keep a physical copy if you need. Just make sure you get all those documents signed. Obviously, if you incorporate through Lawpath or a similar company, you'll get a nice pack that'll be marked up for signature. Make sure you do it, and do it when you get it. Don't leave it down the track because you'll forget. Make sure everything's been ratified, everything's been signed. Basically cover all your bases, or better, don't lose any sleep. Get a lawyer to cover all your bases for you. Make sure that you've ticked all the boxes. ESIC, this is an absolutely cracking scheme that a lot of people are not really aware of. ESIC is early stage innovation company tax offsets. This is not for you as founders. This is for you as founders looking to get external investment. These incentives really make it very attractive to invest in private businesses. This is a non-refundable but carried forward tax offset. So an offset is better than a deduction. An offset is literally getting potentially big savings off your tax bill for your investors. It's capped at $200,000 per investor, but it basically means if you put $100,000 as an eligible investor into one of these early stage investment companies, you'll get a $20,000 tax offset that you can use to reduce your tax bill, and you can carry it forward into the future if you don't need it this year. Very, very attractive. Even better, hold these shares for long enough, or for more than 12 months. When you sell them, if you've invested, you've already got your big tax offset. Fantastic, your company is shooting out the lights. You sell the shares, no capital gains tax. Now, that is huge. That is a real vehicle to build some big wealth, and it's very attractive, and more people should be using it. It's not too difficult to qualify for. There are self-qualification ways of doing it. Again, speak to an accountant. Any accountant worth their salt that knows how to deal with startups will help you out here, and it's not too unaffordable. R&D is close to my heart. I worked in it, probably doing not much else, for about 4 years, not too long ago. Research and development tax incentives are absolutely huge if you can qualify them. When we say tax offset for up to 43.5% for eligible activities, what that means, think about it from a multiplier effect. If you're a really tech-heavy company going in and you've got $1 million to spend building the next great big thing that hasn't been done before, if you spend that $1 million on eligible research and development, and you haven't sold anything yet, you've made no money, you'd think you get a tax bill at zero and on you go, the ATO will refund you that $435,000. You will get that into your bank account. Now, what do you do next year? You spend that $435,000. on eligible R&D activities, and you get another 43.5% back. You can imagine that there are entire segments of the startup community that can only continue to exist through this R&D tax incentive. Now, again, it was one of those things that was in the news a little while ago. For those of you that do like to read it, I won't name them, but there were some promoters out there, some very big promoters that you would have heard of, again, being in the news for other reasons, that took advantage, and some, again, very huge companies that took advantage and were trying to fudge it. And there was a lot of speak at the time that maybe the R&D incentive will not be so valuable. I can tell you I work closely in the R&D segment with startups. It is still there for the taking if you're eligible. So if you work with a proper, reputable provider of R&D tax incentive work, I thoroughly recommend you do it. Now, what's eligible? It's not just everything. If you already know what you're going to build, how you're going to build it, and what it's going to look like, this scheme ain't for you. This is if you're taking risks. The reason why the government's happy to give you 43.5% back is because they want you to take risks. It all comes about. It took off in this form with Malcolm Turnbull and his sort of agenda of innovation. It's still actually regulated by Oz Industry and the innovation team there. What they're trying to do is they're trying to get you to take risks that you otherwise wouldn't have taken. So going, well, look, there's an easy way to do something. It's going to cost me X. There's a really difficult way that I don't know it'll work, but it could be very lucrative. The government wants to fund you to take that path. Now, why might they want you to take that path? Because they want you to get big. They want you to take risks and be profitable and pay back nice income tax returns every year. They want you for the rest of their life to pay tax on that. Frankly, that's a trade-off that most small and startup and scale-up companies are willing to take because it's money now. It isn't a loan. It's a tax incentive. It's your money to keep, so you don't have to pay that back if it works. And likewise, if it doesn't work, you don't have to pay it back. It's funny when you actually write these applications, and it is an application process. What that application should look like is what I used to call a big book of F-ups, to put it more politely. It's supposed to talk about how complicated building was and how maybe you didn't even get there in the end, but no matter, you took some risks. ESOP or ESS, the Americans call it ESOP. Most Australians probably still do too. You might have also heard it called ESS. They mean the same things or different flavors of the same thing. This is employee share option plans or employee share schemes, differently described, same deal. These are a great way to attract and retain senior staff, particularly when cash flow is tight for small businesses. It's a real way to sell the dream and bring people along on that journey with you. If you need a senior engineer, it will maybe cost you $250,000 or $300,000 in the market. And if you can get them for half that and give away a little bit of equity, that's probably a good trade-off, because for a start, frankly, you're giving away something that might not be worth anything in the future. So they're taking a risk with you, but then their incentives are aligned with you. It's in their best interest to make the company work. They're not just there to get a salary anymore. Typically, you will see companies set aside, it says 8 to 10%, sometimes a bit higher, sometimes as high as 15% of equity in your business. You will often just set this aside and not give it away day one. You might keep a little back for people that you want to bring on. Now, a lot of people would think, if you're then seeking to get investors, what will investors think about you saying, oh, we've put aside 10% of our equity for employees? Investors love it. Investors expect it. If you're talking about your big VCs, both in Australia and America, they will almost force you to have an ESOP pool if you don't have one already, because again, they want your senior people aligned with your business. They know that their investment won't work if, as soon as they start to succeed, your best people walk out the door and go to a competitor. These ESOP or ESS shares will typically vest over a period. Vest is not just a nice bit of suiting. A vesting schedule, what that means is you don't get everything up front. There's typically what we call a cliff, that maybe for the first 12 months of you working there, you get nothing. And then every 6 months, you'll get X% until after 4 or 5 years, you've got your full entitlement. And the idea is obviously keeping you aligned, but keeping you motivated to really be there for as long as possible. If you're eligible as a company for these startup concessions, the ESS startup concessions are amazing. Again, I think I'm going to give Turnbull credit for this one. I think it was around his era, but correct me if I'm wrong. But maybe don't correct me, just let me live with it. But these concessions are incredibly good. They're incredibly tax effective for employees, both not having to pay income tax when they get the shares, and then also deferring any taxing point really down the line until they basically sell the shares is pretty much one of the last remaining taxation points. So it's very tax effective. And again, if worst case scenario, the company does fall over, you're not left with a tax burden despite the thing not working. So it's a very, very good scheme. And again, it's one of those things that's called a startup concession, 10 years. So if you're a company that's been going for 9.5 years and you think you're not in the picture, you are very much still in the picture, but get a move on. What are some other small business tax concessions? Reduced tax rates, that's a big one. And this is really stretching the imagination when we talk about what is a small business. The default company tax rate in Australia is 30%. Most businesses, numerically, will only have to pay 25%. That's because they're called a base rate entity. And that is for all companies under $50 million of turnover. So that's most businesses that I would see in my sort of area of business, working with entrepreneurs, will have a much reduced company tax rate, and that's great. There are immediate deductions for startup expenses. Back in the day, you know, if I'm showing my age a bit here, used to have these things called black hole expenditure items, where there was this very silly argument that because you'd incurred these costs in starting up your business before you were generating revenue, that they weren't deductible, that they couldn't be offset against your income. It was a nonsense. It's been fixed. The reality is, in order to generate income, of course, you have to pay things like professional advice and government fees upfront. Of course, you should get a tax deduction for that upfront. So that's really good news when you're starting up a business. Everything you start paying from day one, pre-day one, is tax deductible. There are simplified depreciation rules for small businesses. You don't have to maintain 10,000 assets on an asset register and lose track of it down the line like everyone else does. You can just put them in a pool and diminish them very quickly, 30%. But even better is this immediate write-off. This is why so many tradies, if there's any tradies on the line, if you've got your Hilux or your Ford Raptor in recent years, it's probably been because of this great immediate write-off. It was called temporary full expensing during the COVID mad rush of tax concessions, where basically, rather than getting a little bit of a deduction over 12 years or 8 years of the life of your car, you can claim it all up front. And that goes for all business assets up to a ludicrous cost limit. That cost limit has come back down. These days, if you're buying assets up to $20,000, you will get an instant deduction for that rather than having to depreciate. But I'm just noting caution here. It's held up in the Parliament. I'm sure it will be passed, but it's just one of those irritating things at the moment that's just been a little bit delayed. Going into a bit of detail about what those immediately deductible expenses are, so the upfront costs, it's your professional costs. It's reaching out to the Lawpath to set up your business, paying a little bit of fees to get that all done right, to get some accounting advice on what's your best structure. All of those costs will, and also the accompanying government fees to ASIC, will be immediately deductible. So that does cover most things, frankly, that you pay for startup expenses. I would very rarely see startup expenses that aren't immediately deductible. So that's fantastic. Get your advice, because you can knock it off your tax. Right, the first thing you should be doing, probably again pre-day one, is starting a budget. Now, when I say start a budget, don't do it like I do for my family budget and have a mental spreadsheet that I've long ago lost track of. Put something down on paper. And again, perfect is the enemy of good here. Whatever you're comfortable with, just get it down on some paper. Start up a Word document. Just start writing out some ideas. Just have something you can refer back to. And make it a live document as well. A lot of people think that when you set a budget, you miss it and all hell breaks loose. No. You just adjust your budget as you go. It's actually a very good process for people, even in very senior businesses, to look at and review their budget and say, well, okay, we missed these metrics by an absolute, by a mile. Does that mean that we junk it in or that we need to change the business? No, not necessarily. Maybe things have changed in the economy, in your rivals or in anything like that. You can go back and adjust your budget. That's totally fine. Have that budget meet your business strategy. And again, your strategy's got to be written down. You can have had the idea, in a smoky den somewhere, put it down on paper. Let's not lose track of it. Have that plan, not just for now, but into the future. What does the next stage look like? When are we going to have pain points? For how long can we keep going like this? And how long do we have to come in and change things up, hire new people? Try and understand the market as it sits, but also try and predict the market into the future. Try and gaze into your crystal ball and what do you think is going to be more beneficial or more troublesome about market conditions in the future? And do your research. Look, go out there on LinkedIn, see what's going on. Get in, read the Australian Financial Review. Talk to people in similar businesses. You'd be surprised. You might think that everyone's very discreet and hush-hush about their businesses. I think in Australia, we have a small enough startup and business community that it's actually a pretty friendly place. And if you reach out to people in your sector and talk to them about what they're doing, they might be able to say, hey, just so you know, Joe Blogs down the road is actually doing that and they're really well funded. It might be a time for you to rethink your business strategy. So do talk to people. Expansion considerations. Not many people go into a startup expecting to stay small or wanting to stay small. Often you have your eyes on the prize. You want to get bigger. Now, what that might be is taking over all of the Australian market. It might be going out to the United States, very, very common. A lot of startups will feel constrained by the size of the Australian market and will want to be the next Atlassian. Go for it. Go for it. We have a very good corporate regulation and tax regulation system here that is friendly. You might scoff at that. Trust me, I deal with the United Kingdom and the United States tax authorities all the time, and the SEC. They are a nightmare. Be happy and proud to have started up your business in Australia, and just be in the knowledge that when you're ready to expand, if that's overseas or just internally, there are ways to do it. Just again, keep advice, keep documents, and you'll be fine. What you might be doing when you're expanding is you might be starting up new companies, whether they're an LLC in the United States or a C Corp, or perhaps another company inside of Australia. What else might you need to think about that? You might love your Xero or your MYOB chart of accounts as things stand. They might be doing the job for you. Might be time to either upgrade your system or invest in expanding how those systems work with tracking. Think about how you're going to fund your expansion plans. The debt versus equity one is a real conundrum. The people that offer debt funding like to call it non-dilutionary funding, because the idea is, yes, you're borrowing money, but you're not at the whim of investors and you're not losing your slice of the pie. So maybe there's some debt options out there. If you have a bit of a track record, there are banks that will lend your business money. It's very hard to do day one as a startup to get bank borrowing, but it's possible. Or can you fund your expansions out of profits? If you can, yeah, you're laughing. That's always the best way to do it if you can do it sustainably. Have you got your marketing and sales plan in place? Marketing and sales isn't usually the first thing that startups invest in, but it's definitely the first thing that scale-ups invest in, and it can make or break you having a good marketing or sales plan. Just because maybe you're not experienced in marketing and sales, or you might think you know everything, I do encourage you to speak to the experts because they really know how it's done. Tax leakage, I hinted at this beforehand. This group structure, if you let it go unchecked, if you've got a couple of companies underneath your holding company perhaps, and you haven't done what we call tax consolidation, you could be in a scenario where one of your companies makes $1 million profit and the other company makes $1 million loss. Now the ATO will tell you too bad, you'll pay tax on that $1 million and you'll get nothing for that $1 million loss. So you could end up paying $250,000 in corporate tax, despite your whole corporate group having not made a lick of profit. So there's a couple of ways you fix tax leakage, but again, talk to your accountant. Don't try and do it alone. You can consolidate, or you can set up charges between these companies on a reasonable basis to try and make that level out. Leverage any grants available. Export market used to be a fantastic one. It's the EMDG, pardon me, that's misspelled. It's not as good as it used to be, but it's still available. It'll help you co-fund. The government will pay cents in the dollar on you flying to other countries, going to trade fairs, setting up sales offices overseas. So if that is something you're looking at, definitely look at EMDG. Do you need a CFO? Early days, probably not. As things go, maybe a virtual CFO, dipping in a day a week or even less. But having that real corporate finance function, really quite senior level, it can be helpful just to keep you on track, particularly if you're not particularly financially minded yourself. Cash is king. Get your cash flow forecast. A P&L and a balance sheet only tells half the story. If you know that you have debtors that are slow to pay and you pay your creditors really quickly, you're going to have cash flow issues. So make sure you've thought about that as well. And of course, track your KPIs and seek advice on the unknowns. Don't try and go it alone. Your finance function, I mentioned this briefly before. A full finance function in a mature large company is a CFO, a finance manager, an FC, a financial controller, a whole team of accountants. You can imagine everyone's got their one little job and they do it very well, hopefully. And it's smooth. It's a smooth operation. In the early days, your finance function will have people wearing a lot of hats. Now, if you're a two-person or a one-person startup, you're wearing all the hats and you're used to it. It is a risk if you're doing everything on your own, because I've seen it happen where people try and do too much and they think, well, let's let the finance slide. We don't have a BAS lodgement due for 3 months. I'll worry about it in 3 months. That 3 months goes into 6 months. Okay, I'll get back on track. By the time you do get back on track and you haven't updated your accounting file, you haven't reconciled everything, you can be in a position where you might owe the ATO a lot of money. You might be looking at your books and thinking everything's fine, and suddenly things are not fine. So the reason why when you're expanding that finance function is vitally important is really to avoid those 2 year down the track headaches, those sleepless nights and those love letters from the ATO telling you pay up. It comes in a nice big red banner if anyone's got one. I've had a few of them myself. Pay up or we'll take you to the cleaners. Plenty of startups die at that point. It is fatal. It's actually very, very hard to get back from. So on that uplifting note, please try and keep up to date and review regularly. All right, some taxes, once you go beyond starting up your business and it's exciting, you think, oh, this isn't too hard. You do your company tax return, you do your BAS, it's all quite simple. The next series of love letters that the ATO sends you will really start to give you the panics. Fringe benefits tax is an absolute nightmare. This is, and I know I keep coming back to politics, it may be betraying my interest. Back in the day, the Hawke era and the big Chinese lunches of the trade unions, you'd go out and have these wonderful big meals. Oh, it's a tax expense, it's a tax write-off, fantastic. The government got sick of that because realistically, these are private expenses that are being used to provide a benefit to employees. So they brought in fringe benefits tax. Fringe benefits tax says, we're going to treat every non-cash benefit you give your employee as if you've given the equivalent cash. And guess what? We're going to hit you for doing it. We're going to make that taxable at the top marginal tax rate. So even if you're giving it to someone on $60,000 who's not paying a particularly high level of tax, we're going to treat that as if you're giving that to someone on $300,000. So fringe benefits tax is ludicrously expensive, and even to lodge an FBT return is expensive itself. I really counsel early stage startups do not provide non-cash benefits. You want to keep your people happy, give them some cash, or keep within some of the exclusions to fringe benefits. You might remember, obviously, the Christmas party, that's a big carve out. Maybe a 30 June party if you're that sort of business. Minor and infrequent benefits are fine. But if you've thought what a lot of overseas companies do is they come in and pay health insurance for their employees, private health insurance, they will end up getting a big FBT bill. Typically, if you give an employee a $1,000 non-cash benefit, you'll pay about $1,000 fringe benefit tax on top of that. So you might be thinking you're such a magnanimous employer that you give your employees these benefits, you're going to pay for it. Just give them the cash instead. Payroll tax, that's a state level tax. So it's slightly different for all of us on the call today. Most states during COVID did increase the threshold, so fewer people wouldn't be covered, but that will come back in time. Typically, I think in New South Wales, it's around about the $1 million point. If you're paying $1 million in salaries, then you'll start to pay state level taxes on that as well. Now, that's a real pain in the bum, frankly, but it is a fact of life. Just to have a think about it. When you start to have a lot of employees on board, payroll tax can start to add up. Keep on track. Obviously, if you're reporting frequencies to the ATO, they can change as you expand. If you're used to doing your quarterly BAS and you think that's the end of it, you'll quickly get to a point where if you're hiring too many people, you'll start to need monthly remittance of PAYG, so that tax on employees. But potentially you'll hit the monthly for GST as well. So just be aware that those reporting frequencies do change as you grow. There are lots of things to think about around capital gains tax as you expand. There's some magical thresholds, and I won't tell you why. It's probably a bit of dark science that accountants know about. When a company's worth about $2 million, and then when it's worth about $6 million, we really start to look at doing some transactions around restructuring. There are very good reasons for that are complicated, but there are big CGT, capital gains tax reasons for looking at your company structure around that valuation mark. If you're not sure how much your business is worth, well, that's why business valuers out there can charge a fortune for their reports, because it is complicated. A really, really rough rule of thumb: if you're profitable, if you're trading consistently profitably, I would look at your profits, multiply it by 3 or 4, you're probably there or thereabouts. Now that's for a more traditional sort of business, maybe a service business, but that multiple is going to be higher for like a SaaS business, for those of you that run a bit of e-commerce stuff. But again, talk to your accountant, they will know. Because there are some real important times where it's good to make some big decisions around those restructures. Director loans are a big one. Always keep in the back of your mind, if you've got your business account, you've got your personal account. For one reason, the business account is healthy and your personal is not so bad, I'll just dip into the business. Okay, just be aware that there are rules, they're called Division 7A, if this is giving anyone nightmares. When you are taking or borrowing money from your private companies, you will be expected to either pay that back or set up a loan agreement with interest, or have that borrowing from your company treated as a very, very painful taxable income for you yourself personally. Your accountants will be well aware of this. Certainly at Lawpath, we've been dealing with Div 7A in our sleep since we've been practicing. But a lot of clients aren't aware of it. So just keep in the back of your mind. You might think it's your money. It's not quite your money until you've paid company tax on it. Those family trusts I mentioned are incredibly beneficial. They still are, but there is something called Part 100A that's been there for forever, but it's only really starting to be used by the tax commissioner now to really complicate family trust distributions. It's not a worry for today. It's still very beneficial. It's just they've probably trimmed the edge of how beneficial those family trusts are. Now, am I back to you now, Connor? Have I just spoken so quickly because I had so much excitement?
No, yeah, back to me now. Thanks, Tim. We will break shortly into the Q&A portion of the webinar. So if you guys do have a question related to anything we've discussed so far, please pop that now actually in the Q&A chat there, and Tim can address that at the end. If you actually also want to clarify maybe anything on the Lawpath platform or what we cover, obviously feel free to ask that as well, maybe in the chat bar, and I can answer that for you. We'll do a quick overview of how Lawpath can help, and I want to keep it, really specific to tax and to our accounting services. Most people from the poll, funny enough, have listed tax compliance as their #1 issue for them when it comes to managing their finances. Cash flow, I think, was the second, and most people are only partially confident or not confident at all, which is absolutely fine. I was joking with Tim before we jumped onto the webinar. I don't know if you can see here, we have these thick textbooks behind me on commercial law and Australian taxation law, and I think I could probably read it cover to cover and still not be confident in my own taxes. So if you are in need of someone sort of taking the wheel and improving the financial health of your business, we can absolutely help you with this. If you did, I saw quite a lot of people did join in a bit later, but when I introduced Tim is the head of our Lawpath Tax and Advisory, and he can instill some confidence that your business tax is in safe hands. He does that hands-on work. Some of you, for example, might have invested in the past in a business mentor to kind of get you off the ground from a operational and marketing standpoint. So investing in a competent, knowledgeable accountant, will do the same for you when it comes to your tax compliance and tax minimization. I also, if you scroll up in the webinar chat, you'll see I also listed some additional links to our testimonials and common topics, previous webinars, and existing clients that we have on the Lawpath platform. So just go to the next slide, Tim. So with the tax plan, what we offer is a dedicated tax agent. You have an initial tax consultation. They do all that hands-on work in terms of the annual and quarterly BAS statements, your annual financial statement, which includes profit and loss sheet, balance sheet, notes of the financial statements, and any declarations. And obviously your business tax return, and you also get special year-end fiscal consultation as well. If we just go to the next slide, Tim, for the BAS dates. So hopefully everyone is aware or vaguely aware of what's up and coming. So I think it's in 3 days. If you don't have a registered accountant, that's when your next BAS is due. If you do have a registered accountant, it will be on the 25th of August. And if you have actually registered a new business and you've registered with USD, these are the dates you need to bear in mind for your quarterly BAS lodgements. But if you are, maybe you already are a subscriber, I know a few people in this webinar are subscribers, or you may be looking to get some tax services now. Here's a bit more what you can actually expect with the tax plan. Just pop to the next slide, thanks, Tim. Awesome. So if you do sign up today, our team will reach out within 24 hours. They'll conduct a general assessment of your current company tax status, obviously ensuring you've got no mislodgements, and obviously prepare you for previous and upcoming lodgements. So, if any missing lodgements are identified, we can obviously provide assistance for preparing them and to ensure up to date. Typically, we would have done additional fees for service or anything past due, but with our offer at the moment, we will do your previous tax or BAS lodgement. So just ignore the asterisks there for now. If we just go to our next slide, we have here actually our standalone accounting or tax plan. So you can actually ignore the pricing here as well, as we will show you the offer for all attendees on the webinar. Although we do offer a standalone advice and the hands-on work, but you'll see shortly we also bundle different plans together based on your business requirements. But in a nutshell with Lawpath, if you are discovering for the first time, we do supply businesses with unlimited legal documentation and edits and versions of that. We have over 500 legal documents. These have all been professionally drafted templates by commercial lawyers, and they can be roughly completed within 5 to 20 minutes. And we have something called an essentials package. It's our most basic plan. And I think already about 30% of the users of that single subscription are a mix of lawyers and accountants, and they get actually access to a lot of company-related documents, trust-related documents, and accounting services agreements, different invoices, and employment contracts. The documents are basically built out through the clauses step by step, and you also have some very handy AI tools, including an Ask Me feature, draft, review, simplify, and translate, just to make your life a bit easier when it does come to getting professional legal docs. Let's go to the next slide, Tim. So you'll see here a few of our new bundles options. So if you might not have seen this if you're a current subscriber, but if you are finding this for the first time, we've actually revamped how we can offer the services. The legal advice there is standalone as well, but actually already includes everything in the essentials. But now you actually have the added benefit of unlimited 30-minute consultations and unlimited on-call contract reviews with our lawyers, and they cover the whole range of legal topics. General rule of thumb is if you have a commercial or business legal need, we can assist you within some capacity. But some of the hot topics we cover on the legal advice plan is business structuring, restructuring, business purchase and sell, obviously establishing the contracts you're going to need for clients, for partners, suppliers, employees. Intellectual property and trademarking is a really big ask that we have from subscribers. Debt recovery, startup law, and commercial property law, to name but a few. And on the accounting side, like Tim's covered quite broadly what we advise on. But if you are on the accounting plan, what most existing clients are asking us about is the tax minimization, tax concessions, business structuring advice from the accountant's perspective, and then advice on specific types of tax like your GST, your PAYG, crypto tax, interestingly enough, it's included there now. And then other things like superannuation, trusts, reporting payroll, bookkeeping, and a whole host of other tax and accounting related questions. And obviously with the tax plan there, that is that hands-on work I mentioned earlier. So your BAS lodgements, tax lodgements, and financial statements. So if that is of any interest to anyone here, please type actually yes in the chat box, and someone can reach out to discuss further. They can even actually run a platform demo. So you can actually see it without the limitations of a free account from a subscriber's perspective. Or you can email me, which I included in the web chat at connor_s@lawpath.com.au. However, if any of you were on our RSVP list yesterday, you should have actually received an email from me, a bit of a welcome email to today's webinar. So you can actually just drop me back a question there if anything is on your mind or you are in need of getting our services. Cool. So I think there's just a few questions there. Oh, have you typed in all the questions, Tim?
I've been furiously tapping away. Yep, that's right.
Yeah,
So
okay.
if that's any indication of maybe if you're on the advice plan, a lot of your questions can be dealt with pretty quickly. So if you're wondering if you want to come on board and have an accountant ready to talk to, you might have some issues that will take you a long time, but if I probably know them off the top of my head. So happy to help with those questions, guys.
Yeah, beautiful. Quite a few in there. Cool. So I just want to go to the next slide, Tim, just quickly. So for all webinar attendees, we do actually have 30% off on that tax plan. So if you sign up before July 28th, so I think that's next Monday, you can get basically a $90 per month reduction. So it works out, well, quick maths, about $1,200 savings for the year. That is with our man himself, Tim. He'll do all that hands-on work for you. So if anyone would like to claim that, please reach out to me on the email or type yes in the chat box, and I can give you a call and run through anything you might have questions on. And I guess before we do drop off, if anyone does have any other questions, I think a few more have just popped in the chat there. I think you're typing to them, Tim. But best practice, guys, if you do have some really specific needs and want to flesh a few things more out, then do have a look at jumping on that tax plan or the accounting advice plan, so that you do have that year-round support for your individual businesses. And I know a lot of people on this webinar as well will be accountants themselves, so if you are kind of in need of having really quick and accessible legal documents, do feel free to reach out. Happy to run a platform demo as well of the platform, so you can see how we customize documents, how we use the AI tools, and the respective workflows. You're a quick typer, Tim. Just give it a few more minutes. People can ask a question.
Yeah, put me to the test, guys. You got me for a little bit longer at least.
Yeah, so Ben, you might have to scroll up, maybe I'll repost it, but if you just scroll up in the webinar chat.
And I have just seen there are some other questions in the general webinar chat as well. Ray Clark has come up with divisible by 6. Yeah, that's a pretty common thing as well when you got a number of shares. That's pretty clever too. But 10,000 or 1,000 is fine as well.
Yeah, so you can access our other webinars on the YouTube page, where we go through a series of different legal topics. We had a rather large one last week on employment, as well as my webinar on actually using some of the tools on the software side for Lawpath. So if you just click the YouTube link there, Ben, that will take you there. I think Karen's written Ben, but I think she means you, Tim.
I'll have a look at that one. Which one am I looking at? Sorry, Connor. I've seen one from Michael.
That's so good.
Good point. Clients in the travel industry. I do.
Yeah, it's a great question, Michael. Yeah, if you are looking for some, additional support with 2 different companies, it would be one tax plan per company, essentially. But you can get advice on both businesses on a single advice plan. So whether that's the legal advice or accounting advice or legal and accounting advice bundled together, you can have clients with 5 businesses all on a single advice plan. So in terms of plans for accountants, there's not like a specific accounting plan, but most of the accountants using Lawpath are on our essential subscription, so they can supply their own business with legal docs or supply their clients with legal docs. Otherwise, a lot of accountants are actually using Lawpath to register companies. I think our CMO told us last week, the other week, a couple of weeks ago, about out of 12,000 registered accountants, about 8,000 are using Lawpath, including my.
So I certainly used to before I worked at Lawpath. I used to use Lawpath for registrations. It's a great platform for doing that.
Really popular. And same on the now we have the AI. Same on the legal front as well. And a lot of lawyers who have no affiliation to Lawpath are using the draft feature. So it's a good indication it's doing as intended. There's no complaints there. But it's a very specific AI on the legal side. We'd expect it to. Cool. All right. I guess we'll leave it there. Thanks for everyone to attending. I hope the information provided was really helpful and kind of build on your knowledge base. If obviously you guys do need that hands-on work ahead of the BAS lodgement and last year's tax returns, do get in touch. We can help you cover that on our tax plan with 30% off. And if you need more support on the documents or legal side for the business, we can absolutely help there as well. All right. Any final words from you, Tim?
No, just a thanks, really. I mean, thanks for giving up your lunch hour and change, or you know, I just always appreciate the opportunity to talk to people that potentially are not being well served by the current accountants or aren't aware of what they don't know. So hopefully I've given you some food for thought. Look, you've got Connor's details. Please reach out if you'd like to keep the conversation going with us. I'm very happy to have more conversations and just keep everything going. And I'm sure there'll be more webinars in the future as well, where you'll get to see my pretty face.
All right, Twizzy. Thank you, everyone.
I'll just quickly answer the last couple of questions that have come in, but thanks from me as well, everyone.
Cool. Yeah, we work with all accounting softwares. Actually, I saw a few people on the poll listed they're doing a lot of their stuff manually still, not using any accounting software. Would advise for convenience jumping on an accounting software. Not a lot of people use Xero. We do also have an exclusive offer with Mile as well. It's about a 30-day free trial, and then it's 50% off for the next 11 months. But it is actually just a month-to-month rolling contract, which is pretty good if anyone wants to check that out.
Connor, Stephen's just asked for your details as well. If you can just pop that in the chat.
Yeah, Stephen. So it's Connor, COO, full stop S at Lawpath. You should also, hopefully, if you were on yesterday's RSVP, you should hopefully have an email from me in your inbox, Steve.
All right, we might wrap things up then.
All right. Thank you, everyone.
Thank you.
Thanks, Tim.
Pleasure.